Welcome to the Rick Helps Real Estate Show, one of our weekly editions here where we kind of take a look at the past week and see what we can find out. And the one thing that we can be assured of right now is there's no clear direction. Now, real estate is a long term, I want to say game, but it's not a game. You're trying to find a home to live in. There are investors out there that really concentrate on the short term. So they look at different numbers than I do. And so you're trying to project out long term. Is this a good time to buy? Is it a bad time to buy? Can I even buy? And that's the market that we're in. And we're kind of in uncharted territories as well, because we've never had this much money injected into our monetary system ever, and now trying to pull back from it. And that's what the central bank is trying to do. So all eyes were on the press conference of what kind of rate cut we were going to get. Everybody expected a 0.25 cut. That's what we got. And what was the impact? It was more of the same. This is 10-year treasuries. This is really what mortgage rates are dependent on, or we're at 4.14, well, 4.17. So you can add 2% to that, get you up to 6.17, and that's where our rates are. But you can see they have not moved. They were higher up here in January at 4.79, 4.77. That's when you were sitting at about a 7% mortgage rate. But overall, we've just been saying, as Pat and I have been saying for a long time, muddling along. Now, what does that mean for us? Well, there are so many different scenarios. I'll run through some numbers, show you where we're at. But real estate could do anything in the next few years. We could stay stuck where we're at. And I'm seeing more and more articles and stories saying that that's probably what's going to happen. We're going to be slow, steady, income slowly rising, house prices slowly adjusting downward. Not flying off the face of the earth, but slowly adjusting downward. That all depends on unemployment. It all depends on interest rates and the overall economy. So there's just too many moving parts. Now, there are plenty of scenarios too that say everything could fall apart. Banking could lose its liquidity, and here we go. A little bit of chatter this week where the central bank said they were going to stop QT, quantitative tightening. Okay. And we're in a good neutral position, he said. In other words, we're kind of sitting in this zone where we can go either way. Print more money or tighten, depending on what we see. Because you know what? They're not getting the data that they want because of that stupid government shutdown. So they're waiting for some consumer price index numbers, some unemployment numbers that they can depend on, and they're just not seeing it. So if we look at our unemployment rate on this chart, this goes all the way back to December or August. It's not going to be updated until December 17th. So we're showing our market area at 3.8%. Well, what is it today? They don't know. So they're kind of waiting to see what is going to happen there. Now, Chairman Powell also said that he was going to stop quantitative tightening and didn't know when they would start it back up. They weren't going to do quantitative easing. But less than 12 days later, they started firing up the printing press and started buying treasuries. 40 billion at a whack. And so that's kind of quantitative easing. QE light is what I guess I would call it. So who knows? Now, here's where we're at in our market, showing us here that all these arrows are turning green. Anything above 100 is considered a seller's market. Below that, balanced, and then a buyer's market. And buyer's market's kind of where we've been overall, but it certainly looks better on the chart when it comes to this chart that measures supply and demand. Why? Well, demand is kind of staying steady. It's down a little bit, but what we're seeing is that the number of new listings coming on, this yellow area here, is falling off the face of the earth because it's the holidays. Contracts are going down. They've recovered since Thanksgiving, starting to ease down a little bit, but we still hover at this 2,700 mark. That needs to break through in order for us to say that January is going to look good. That number has to really crank up. I don't see it. I see us maybe getting to 2,800. I'm looking at our active listing count. Again, it's following the seasonal norm of declining, a little bit more rapid rate now than what we saw the past couple of years. But it is coming down. People are pulling their homes off the market for the holidays. Here's pending listings. just hanging right in there. They were last year and the year before that. They're not moving. They're just hugging. Like I joked the other day, it's as if people are phoning ahead. But here's a listing success rate by calendar month. It's measured weekly. This is not a good chart when it comes to seeing how well listings are selling. And we're sitting here at a rate right now of 64%. And that's kind of down at the bottom tier here. Now, down here, nothing was sold. Look at that. After the big crash we had, listing success rate of 21%. 80% of you were not selling your home. We got down to a low here in December of 2022 of 61% and peaked at 93% during what I call the silly season of 21. So listing success rate right now, it ain't great. Best way I can put it. Months of supply. Here's what I'm going to go into great detail with Dan Friel. I'm going to be talking to him later on this week about the over 55 communities. Look what's going on in Sun Lakes. Last year, they had 3.6 months of supply. Right now, 6. They've almost doubled when it comes to the number of homes down there in the over 55 communities. Why is that? Canadians. Canadians are not coming down. They're leaving for a lot of different reasons. We're going to go into that in a few days. But the Canadian dollar is down to 71 cents. So they're sensing an opportunity to sell and get out. And it seems to be happening in those communities at a much broader level than anywhere else in the valley. So we're going to touch on that a little bit in a few days. Here's days on market here showing that this month of the houses that sold, they were on the market for 83 days. But right now our active listings are sitting at 102 days. It's not getting better. It's getting worse. The other thing to follow, and this is what the big money guns follow here, and this is our money supply. This is why I alluded to earlier, showing you this graph, how much money was injected into the system after COVID and how it continued to climb and climb and climb. And then we kind of flattened out. But right now, why is money supply climbing? We're not printing more money. We're not injecting more money into the system. What's going on? So bond traders are going to be looking at this and watching this closely. I don't have an answer for you on what that is, but it is a measure of whether or not we have too much money chasing too few goods. Because if we have another round of inflation, guess what goes up? Real estate, gold, stocks. Could real estate go up again? Yes, it could. Will we like it? No, probably not. This is why Chairman Powell on the other day, I believe it was Wednesday, said, I can't do anything to improve housing. Now, what does improve housing mean for you versus what it means to him? For him, improving housing simply meant, I can't get the prices down for you. He could jack up rates at 10% and make the whole system implode. Many of you would like that, but he's going to end up hurting a lot of different things, primarily the interest that we're paying on our debt, which is $1 trillion more than what we're paying on national defense. So his eyes are looking at that more so than he's looking at housing. And what he's saying is, I can't build houses. I can't control the inventory, and that's our problem. So until we get some kind of fix there, house prices are going to be out of reach for a lot of people. He's just saying, don't look at me to solve that problem. He's kind of winking at Congress going, you might want to look into this. So it's going to be an interesting couple of months. I think I'm going to stick to my guns and say January is not going to be the stellar month that some people think it is. Agents are already saying, man, this is going to be a great spring. I don't know. I won't know until I see what happens around February. We're going to have a lot of new listings showing up in January. They're not going to sell as much as people think they are. We may have another rate change. It all depends on what the bond market does, but I don't think it's going to be by leaps and bounds. The majority of people and companies that track and forecast interest rates are sticking to their guns at slightly above 6% for all of next year. But then again, I can find you another study that says we'll be down to 5.2. So we don't know. We're just going to watch it here on this channel. I'll keep showing you what we see in our local numbers, and we can base our decisions on that. Until then, have a great day. Take care.